PwC presents India Tax Talks in association with CNBC TV 18.
Hello and welcome to PwC presents India Tax Talks in association with CNBC TV 18. I'm Surabhi Upadhyay. Finance Minister Nirmala Sitharaman will present the full year budget for the year ending March 2020 on the 5th of July. It will be the first budget of Prime Minister Narendra Modi's second term in office. That's Modi 2.0. So what are India Inc.'s expectations from the budget this time around? Should we expect to see any significant tax changes? Should we expect any significant policy announcements? Well, to take this conversation forward, I have with me 5 experts in the studio right here. Prabal Banerjee, Group Finance Director at the Bajaj Group. Ramesh Swaminathan, Head Corporate Center at L&T. Jogendra, Sethi, CFO at VIP Industries. Neelesh, Talathi, CFO at Pepperfry. And Frank D'Souza, Partner and Leader, Corporate and International Tax at PwC India. Gentlemen, thank you so much for joining in. So I want to start by getting your first quick 30-second thoughts on whether you are expecting anything significant on the 5th of July. Why don't you start first, Prabal?
We are expecting actually there should be some moderation in the income tax rate because other countries are reducing the rate for their investment. So India should not lag behind in that case. In case of India, basically we have tax rates basically which are around 34.6%, and then there is a DDT of around 20%, so which effective rate comes on the corporates itself more than 40%. While as compared to basically when we see the USA, which has reduced the rate already from 35 to 21%. And if you see the BRICS countries, there's the countries like Russia having 20% rate, and South Africa around 28%, and in case of Brazil, it is roughly around 34%. So as a country, I think we should take, because if you want an investment in the, and this will also encourage the local industries also to do more investment, so which will drive the more employment generation, which will increase the investment opportunities, and the overall economy will get a good boost in this case.
Ramesh, let's get your thoughts. From a taxation standpoint, does the government need to do anything right now? Because there are sort of arguments on the other side. When you're looking at setting up a DTC or a direct tax code, then why do any tinkering around, piecemeal basis on the 5th of July anyway? Your thoughts?
No, I agree with what Jogendra is just saying, that the tax rates in India are pretty high. So he reeled out the tax rates in a number of countries. So for sure, there is in fact a lot of room for reduction, and that's exactly what the her predecessor actually said. Jet Li said the fact that he would like to bring it down to 25%, and he would remove exemptions, and I'm okay with both. But the fact is, I don't think there's too much of room for doing all of this in the current context. If you look at the engines of the economy, nearly every engine is really down. If you look at exports, it's kind of slowing down. If you look at consumption, it's been slowing down, both durables and non-durables. Investments are down. Government spending, that's the only way they actually brought down the fiscal deficit to about 3.4% by actually reducing it to the fourth quarter. If you look at the GDP growth rates, they've been coming down over the last 4 quarters from 8%, 7%, 6.7% to and 5.8%. And we do expect the first half year to be in fact lower, perhaps because of to be around the 6.7%, perhaps going up to 7.2% in the second half of the year. So I do think that Nirmala Sitharaman's hands are really tied. It's not going to be easy at all.
Absolutely. Mr. Banerjee, so opening thoughts, because the question is whether you give up a little bit on fiscal prudence right now to provide that stimulus that perhaps the economy does need. Your thoughts?
You see, while there is minor tweaking is always welcome, I do not think the government has the headroom for doing very major changes in the tax structure, although part of it will be needed, particularly whether it is DDT reduction or rationalization of the tax rate itself because of existence of surcharge as well as the cess. The question that remains, whether it is corporate tax or individual tax, I think the important thing that is essential for our country today is to boost up the investment in infrastructure as well as in non-infrastructure sector. For that, whatever is the taxation review has to be done, and I do expect some amount of tweaking will happen in the tax rate, but I do not see or expect any major change in the tax rate for the simple reason that is the only source of income for the government as of today, and they should actually garner that resource and put that back in the spending of infrastructure, and other related issues.
Neelesh, your thoughts on whether, from a tax point of view, you think this is the time to do something big?
With the sort of mandate that this government has, I think there are two areas I would think that this government should focus on. One is to boost demand in the economy. There is all headline numbers coming our way, which is saying that this is now the time to put something right, otherwise we'll get into bigger problems. And therefore, this is now the time to act and get demand going right in the economy. The other sector that I would rightly want the government to focus on is the sector that I come from. India is a $45 billion e-commerce market. The potential is to become a $500 billion e-commerce market. This is a very exciting industry, and there are specific requirements of this industry. We are leapfrogging the entire world in what's happening in e-commerce, and I think this is again the time for the government to be doing something about it.
But Frank, you don't really envy the finance minister's position, do you? I mean, you have a paltry sum of funds, and then there's every sector crying out for tax reduction. It's a tough balancing act for the lady, I'm sure.
No, it clearly is, and I agree that she has very limited room in terms of how she can maneuver in respect of either giving further exemptions or reducing the rates. I think in my mind, it is more important if she lays out a roadmap in terms of what she will achieve or seek to achieve over the next 4-5 years, just like Jaitley did in his tenure. And I think that provides certainty and builds up appropriate expectation in the market in terms of where this is moving. And she has to be candid about what the challenges are, what needs to fall into place for that to happen. But at least when that is done, okay, I think it provides a direction. Everyone knows that our tax rate is going to go down to 25%, which is good. Something along the lines that Mr. Banerjee said, that do we really need to have surcharge? It was introduced only on exceptional. It's supposed to be introduced only for exceptional situations. Do we really need to have cess? Do we really need to have such a high DDT? How are we going to deal with MAT when you have things like ICDS, which is in there? You have new accounting standards which are coming in. So there is so much of change which is taking place that people are actually struggling to keep pace with the compliances which are being thrust upon them. So if she lays out a roadmap of where this is going to go, in my mind, that is a good budget. Her room for making too much changes is something which will be tough.
I want to get this panel's view on two contentious taxes. They're very sort of, touchy even from a capital market standpoint. One is the capital gains tax and the second is the dividend distribution tax. And both have been big bugbears now for a while. So let's see what could be the way forward. At least what's the India Inc.'s sort of, proposed way forward. Jogendra, your thoughts? I mean, dividends are right now taxed at two levels, company level and also the individual level if the amount crosses 10 lakh rupees. If you were to suggest a regime tweak or change, what would that change be?
Yeah, because in this case, because there is a corporate with a profit on which already the corporate tax is applied. And then subsequently for the distribution stage, then again there is a dividend distribution tax is applied. And as you rightly mentioned, actually, then last year it was introduced Section 115 BBDA. Basically under that, individuals and firms basically have to pay another 10% of if they exceed the dividend of more than 10 lakhs. So this actually totally discourage that entire process of investment also, because when we are looking for that not only that bigger people, the general public should also start investing in the market, so which will give the growth perspective. So if basically we keep up putting so many layer of taxes on the same profit which is generated by the profit, then it discourages that entire system.
Let me get in, Frank. Frank, this level of dividend taxation, what we have here in India, is it in conformity with the global norms?
Not really. Not to the extent that we have, and especially not to the extent of having the double taxation in certain cases now from the previous year, even on the individuals' firms and firms in terms of the dividend income that they receive. If we just step back and think in terms of why DDT was introduced in the first place, the government was struggling to actually collect taxes from the people who were receiving and earning dividend, because the compliance regime at that point of time or compliance was pretty low. Now, we have shifted that needle quite significantly, right? Compliance is more robust. It is easy for them to go after people who earn income. There is data which is available to them. So if you really step back and think about it, is that the rationale in terms of why the tax was introduced or converted to a dividend distribution tax no longer exists. And if that is the case, then isn't it time for it to go? And it took a life of its own, right? It started off at 7.5% and is at 20%. So the question is, and in my mind, it is nothing but a corporate tax. It just increases the tax burden on the company, increases the tax burden on the investors. It in fact goes and harms the small taxpayers because their take home is reducing because of the fact that there's a DDT which is getting paid. So, and given the fact that we have such strong compliance now, our ability to monitor compliance, if there is none, is time to actually move back to the old regime of taxing dividends in the hands of the recipient. And at the slab rates at which they are, they'll go ahead and pay the tax.
Okay.
I think that's what is needed.
Okay.
But that will, in any case, will actually discourage the investors to be, because please let us identify the people who get dividends, except in a couple of circumstances, are actually long-term investors, not speculators. They want to actually see this as a steady source of income as far as they are concerned. They have invested like big companies like Hindustan Lever, L&T and all other companies for a long-term steady state income coming into their bank account. You tax that at the average of 60%, almost 45-50% in the company, and then again you tax it at the recipient level. You know, people will think that what is that we need to do with this money? Everything that they actually have as cash will have a negative carry as far as the common people, common investors are concerned. I think it is better that I do not encourage that, yes, there is enough headroom, so you actually abolish the DDT. You moderate it down, tweak the rates down.
Okay, gentlemen, I do need to take a very quick break. This conversation is not going anywhere. We keep discussing the route forward for not just the dividend distribution tax, but also the long-term capital gains tax. Is there any need to have a second look at that regime if you're trying to boost sentiment and just improve the overall investment climate? We're back in just a moment.
PwC presents India Tax Talks in association with CNBC TV 18.